Welcome to Good Revenue. I'm Neetha Bidway, and this week we're going to talk about a private equity update, secondary markets, and we'll also dig into what's going on with inflation. As always, you can find links and resources in the show notes, and if you haven't already, hit the subscribe button. We would love to have you back. Thank you for joining us. The money can't move. Investors are trapped because billions of dollars in assets can't move. Here's some of the data. Private equity currently holds anywhere between $2.9 to $3.2 trillion in unsold assets. And if you think about that across PE portfolios, it amounts to 29,000 companies in private equity, according to Bain. That number is actually up. Last year, it was at 28,000. So it's a massive number of companies, and the data we're about to go through has wide implications across a whole host of different sectors. Now, it's particularly tricky because heading into 2025, private equity and the markets generally thought that this would be a really good year. But the data at mid-2025 doesn't quite hold up. Here's some of the information that we found. First off, buyout deals were up 37% in 2024, and exits were up 34%. That's also from Bain. In Q1 of this year, 2025, things looked pretty good. And you might remember that in Q1 of 2025, there was a $23 billion buyout agreement for Walgreens made by Sycamore Partners. That deal hasn't closed yet, but it is expected to at the end of 2025. But momentum has stalled. Since the deal was announced, tariffs and policy has really slowed down deal trajectory, also according to Bain. And heading into Q2, things got a lot tougher. Deal volume was down 22%, value was down 24%. When you look at exits, and this data comes in from PitchBook, there were 732 exits by mid-2025. And last year, 2024, at the same time, there were 1,393 exits. 53% of holdings are older than 4 years in private equity portfolios. The median hold time is actually 3.5 years, when it used to be 2.7 back in 2020. Fundraising is also at its weakest point since 2020. $149 billion was raised across 146 funds in the first half of 2025, compared with $333 billion across 476 funds last year. In that number as well are two huge deals for Two Toma Bravo funds. That accounts for 20% of all capital raised. Middle market raises have also dropped. They're as low as $59.9 billion. And to hit a 20% IRR now takes double of 2020's enterprise value growth, according to PwC. So across the board, the liquidity crunch is on, investors are feeling the pinch, and that is drawing energy to an escape route, which is the secondary market. The rise of secondary markets can't be overstated. There's a huge surge, and both Bain and PwC say that secondaries now touch 30% of all buyout portfolios. Both private equity and venture capital are flocking to the secondary markets, and the deal volume globally is at $155 billion in 2024. That number comes from S&P Global. The VC secondary market is already in excess of $20 billion. There are a few different types of secondary structures. There are LP-led, meaning the limited partners are selling fund stakes to new buyers who are going to take on all the risk and the liability. There are GP-led continuation vehicles. That's where the general partner is rolling or selling assets to a new vehicle. So the limited partners are able to either cash out or they can roll over into the new fund. And then there are direct funds as well. And that is for early shareholders or venture capitalists that are looking to sell shares pre-exit. Something to note looking at that huge market, according to S&P Global, 50% of it is actually comprised of those GP-led vehicles. So big funds, GPs, and secondary funds are doing deals across both private equity and VC. Only 12 secondary funds actually raised money by mid 2025. They raised about $38.8 billion. There were 215 funds that are still seeking capital. So there are more sellers than there are buyers, according to S&P Global's data. Thinking about all of this in the context of rising inflation, it is likely that these markets are going to continue to boom, but the music hasn't stopped yet. Inflation returns. Now, you've probably been seeing some of the news stories about the recent rise in inflation, but I thought that it might be helpful to actually go back and look at where inflation has been over the last 5 years, because if you're like me, you probably memory hold all of this, and I think it's helpful to see the numbers. So back in 2020, when we were in COVID, inflation was at 1.2%. By the next year, 2021, inflation rose quite a bit. It averaged 4.7% across the year, and it hit 7% in December of 2021. Now, inflation peaked in June of 2022 at 9.1%. And since 2022, the Fed has spent a lot of time trying to wrangle inflation. And for all of us, that means interest rates have continued to increase with a few exceptions. So as of April 2025, inflation was brought back down. It was 2.3% in April. Unfortunately, in June of this year, inflation crept back up to 2.7%. So that's the highest amount in 4 months. And that made a lot of people really nervous. The reason being that the driver of inflation is tariffs. And this comes from a host of economists, including folks at the Council of Foreign Relations. The challenge is that prices have already started to creep up. So cars, clothing, shoes, electronics, food, all of those are more expensive. And the cost of tariffs currently is at historic highs. We've talked about this in a couple prior episodes, but we're in excess of 20% tariffs for the first time since 1910. These tariffs don't even include the latest tariffs announced by the administration. And those tariffs affect things like copper and pharmaceuticals. So huge, important sectors. And if those tariffs go into effect, experts expect inflation to rise even more. The real challenge here is that the Fed has a really tough choice. They can cut rates, and that will risk more inflation, or they can try to leave rates where they are, and that might reduce the amount of growth that we get. So it's a tough job, and it's likely to stay pretty hectic for the Federal Reserve, especially given the fact that they're under a lot of pressure from the administration. But it's definitely a Hobbesian choice. As always, thank you so much for joining us, and we'll see you here soon. Thanks for listening. If you liked what you heard, leave us a review, subscribe to the show, or check out another episode. We appreciate your support.